At the beginning of the decade, the gold price was an admittedly price-controlled $35. At the end of the decade, the price was $850. Now, I'm not suggesting that gold is going to go up 30-fold in this circumstance. I am merely suggesting that people who own gold, because they think it might go from $1,950 an ounce to $2,200, are missing the ship. You buy gold because you are afraid that it's going to go to 5,000 or 6,000 or 7,000 or 10,000.
Hello everyone, and welcome to WealthWise. In recent developments, gold prices have shown a pattern of stabilization, and this can be attributed to the statements made by Jerome Powell, who serves as the chair of the U.S. Federal Reserve. According to Rick Rule, there is a looming possibility of further interest rate hikes, which has led market participants to eagerly await economic data as a guide for predicting the future direction of interest rates. So, before we dive into today's video, please take a moment to subscribe to our channel and click on the bell icon to ensure you never miss any of our updates.
Government on balance sheet owes $33 trillion. That's with a T. That's 12 decimal point, 12 data points to the left of the decimal point. But that's not the worst of it. The net present value of obligations of the U.S. government, things like Social Security, Medicare, Medicaid, that adds over $100 trillion to the recourse liability of the U.S. government. So as Americans, we owe each other, or more precisely, the spenders owe the savers, something like $130 trillion. Putting that into perspective, about 5 times nominal GDP. And we propose to service that debt with a budget that's in deficit $2 trillion per year. That's the first part of the nervousness. The second part of the nervousness is inflation and the perception of inflation. I have given it a lot of thought. And the first thing is that people who are afraid can't be numbed into inaction. You have to do something about it. At the very least, you have to think about it. I think that the impact will be, in boxing parlance, severe, but survivable. Remember that I cut my teeth in business in the decade of the 1970s. In the decade of the 1970s, the dollar lost 80% of its purchasing power from beginning to end. People that owned long bonds in the 1970s got obliterated. They didn't get hurt. They got obliterated. People who took action, and there were various courses of action that you could take. Warren Buffett, as an example, bought very high-quality companies that had such market dominance that they had pricing power. And he did well. The stock market did poorly, but Buffett did well because he didn't chase fads. He didn't have a fear of missing out. He bought high-quality companies. But the asset class that did the best was gold. At the beginning of the decade, the gold price was an admittedly price-controlled $35. At the end of the decade, the price was $850. Now, I'm not suggesting that gold is going to go up 30-fold in this circumstance. I am merely suggesting that people who own gold, because they think it might go from $1,950 an ounce to $2,200, are missing the ship. You buy gold because you are afraid that it's going to go to 5,000 or 6,000 or 7,000 or 10,000. Most people have been lulled into a sense of security by the fact that in the period 1982 to 2022, we went through 40 of the most benign economic periods in the history of humankind. And people's anticipation of the future is set by their experience in the immediate past. The consequence of that is that there has been too little fear. It's important to understand this. Precious metals as an asset class comprise 0.5% of the savings and investment assets of Americans across the country. The 4-decade median is 2%. I believe that gold and precious metals assets will return to mean, meaning that demand for them will increase 4-fold. I don't have any idea what the impact on pricing will be, but I suspect it'll be much more dramatic than other people think it will be. how much protection you want, whether you regard the asset class as an investment or a speculation. So let's go through the options. I suspect that everybody should start their gold portfolio by owning gold itself. The least troubling, the least risky way to own it. Own it in a segregated account, that is to say, gold held in your name at a storage facility that you understand, a Brinks, a Loomis, a Viamat, not in a vaulting facility owned by Schlepp, Schmuck, and Schmo, who might run off with your gold. Ones that people need to consider before they implement midnight gardening. I am not an enemy of the ETFs, or in particular the Sprott physical gold certificates, which are to say exchange-traded, audited hoards of gold, where you control evidence of ownership rather than the gold itself. As I age, it is easier for me to own gold in surrogate form and trade it with the click of a mouse at much lower premiums than you pay for physical gold. If you are looking at gold as an investor rather than as an insurance product, you should look at the senior gold stocks. You have implementation risk and you have leverage both on the upside and downside. But this requires some risk and it requires some work. If you're a speculator, if you are attracted to the fact that the junior gold mining shares are some of the most volatile securities on earth, securities that can give you 10-fold or 20-fold returns in gold bull markets, understanding the risk and understanding the volatility, and you're prepared to do the work, understanding or differentiating between the good, the bad, and the ugly of the junior gold stocks, that's certainly very fertile ground. It's a business that's treated me very well. But most people can't stand the risk, they can't stand the volatility, and they aren't willing to do the work. So the answer to the question really depends on the psychological and financial makeup of the person asking me the question.
Rick Rule also points out that the U.S. government's debt is undeniably significant, officially standing at approximately $33 trillion. However, when we take into account future obligations such as Social Security and Medicare, this daunting figure actually surpasses a staggering $100 trillion. Over the past decade, the U.S. government's debt has nearly doubled, reaching close to $33 trillion, which is equivalent to a substantial 122% of the nation's GDP. Fiscal spending has surged, particularly since the onset of the pandemic, and there are minimal signs of this trend slowing down. This continuous surge in spending has led market expert Larry McDonald to describe it as a mind-blowing hole in the country's financial situation. With each instance of fiscal instability and fluctuation in inflation rates, the appeal of gold as a reliable means of preserving wealth and seeking refuge from the turbulent financial landscape becomes increasingly apparent. What are your thoughts on the interview? Share your opinions in the comments section below. See you in the next video.